Fed is losing credibility. Now, Warsh is getting a credibility problem. The markets gave him some credibility. And remember, I kept saying from the beginning, the whole idea that he's going to be an inflation hawk, that he's going to be tough on inflation, that he's going to be another Paul Volcker was all BS. That there was no chance that that was going to happen because politically it can't happen based on the economic fundamentals. The fundamentals are we have so much debt, this whole economy is such a massive bubble that if we actually tried to do what Paul Volcker did, we would create an economic condition much worse than what they perceive the threat to be from inflation. So they're not going to do anything. But at this point, I think the Fed is now damned if they do, or we're damned if they do, and we're damned if they don't, because even if the Fed doesn't hike rates, the markets are going to crash. If it does hike rates, they're going to crash even more.
The Federal Reserve is rapidly losing its market credibility as its aggressive monetary rhetoric completely fails to match its policy decisions. Central bank leadership insists on a firm commitment to restoring price stability, yet key interest rates remain frozen despite escalating inflation concerns. Peter Schiff, an influential economist, financial analyst, and author, emphasizes that monetary authorities are trapped in a severe structural dilemma caused by unsustainable national debt. Attempting an aggressive rate hike cycle akin to past historic policy shifts would provoke a severe economic collapse far worse than current inflationary threats. Consequently, financial markets are predicted to undergo a dramatic crash whether officials choose to raise benchmark borrowing costs or maintain the status quo. If benchmark rates are hiked, market valuations will collapse even more sharply as bubble conditions burst under higher debt servicing burdens. As institutional trust in government assurances continues to erode, broader equity indexes will inevitably follow bond markets into a major downward trajectory. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
If this guy really is committed as he says, to bringing inflation down to 2%, why did he waste 2 FOMC meetings and not hike rates? Even when the market was at least opening the door to an expectation that rates were going to go up, why not do it? Why not put some, words and put some actions behind your words? There's one of two possibilities, right? Either, words is all he's got. He really doesn't want 2% inflation, or he'd take it if he can get it. But he doesn't want to do what it takes to get it. He doesn't want to make the trade-offs. He doesn't want to make the choice. So he's thinking, look, if I can get 2% inflation just by talking about it, then fantastic. Because he wants to avoid the other trade-offs. He wants to avoid recession. He wants to avoid stock market crash, real estate crash, financial crisis, all these things that might happen if he really did what it took to bring inflation down. So he doesn't want to do it. He wants to cheat. He wants to see if I can get it down just by talking about it. Well, that's obviously not going to work, right? And if he thought it was going to work, he should know by the market reaction, which I'm going to get to, that it is not going to work. And the other possibility is it's all the markets. He knows that the markets are going to go down if he hikes interest rates, so he's not doing it. But he can't say that, so he just has to keep pretending that inflation is going to come down somehow because we got a tough guy in town who's going to talk and talk and talk, and hopefully the markets will move based on that, based on just that tough talk. Speak loudly even though you don't have a stick, and he's hoping that the markets don't realize he doesn't have a stick. Well, what's happening now is the markets are reacting to this apparent disparity, the complete, difference between the Fed's words and the Fed's actions. And now the Fed is losing credibility. Now Warsh is getting a credibility problem. The markets gave him some credibility. And remember, I kept saying from the beginning, the whole idea that he's going to be an inflation hawk, that he's going to be tough on inflation, that he's going to be another Paul Volcker was all BS, that there was no chance that that was going to happen because politically it can't happen based on the economic fundamentals. The fundamentals are we have so much debt, this whole economy is such a massive bubble that if we actually tried to do what Paul Volcker did, we would create an economic condition much worse than what they perceive the threat to be from inflation. So they're not going to do anything. But at this point, I think the Fed is now damned if they do, or we're damned if they do, and we're damned if they don't, because even if the Fed doesn't hike rates, the markets are going to crash. If it does hike rates, they're going to crash even more. So it's not that the Fed can look at the market reaction to their lack of a hike and think, whoa, that means we have to hike. No, because when they actually hike, it's going to even be worse for the markets than the sell-off from the non-hike. But I think we're at a point where regardless, the markets go down because the Fed can't keep sending these missed signals and losing all of its credibility. Because once you realize that the Fed is just BS and Warsh is just talking, that is a big loss of confidence, especially for the bond market. And if you're losing confidence in the bond market, well, the stock market is going to follow. And what happened to bonds today? Yields rose. The highest I saw, the 30-year Treasury, was 5.22% on the day. That is the highest it's been in about 20 years, before the 2008 financial crisis. So this is a new high. The yield on the 10-year didn't quite make a new high because it got to 4.69. So still didn't see it above 4.7, but we could easily be there by tomorrow. But the decline in bonds is why the stock market sold off. In fact, the market was down before the announcement. In fact, I think maybe on the lows, the Dow was down 700-800 points. And the NASDAQ was down not quite as much percentage-wise because it got killed the prior couple of days. But when we didn't get a hike, we got a rally in the market. I mean, the Dow didn't go positive. I think it may have been down 300, 400 points at its best. But the NASDAQ reversed and went positive. But when the bond market rolled over and sold off, even though the Fed didn't hike, and in fact, not hiking is bad for the bond market because it shows that the Fed doesn't really have zero tolerance for inflation. In fact, I interpret what Warsh did today, leaving rates unchanged, as choosing inflation. That's what he chose. He told everybody inflation was a choice, and then that's exactly the choice that he made. Well, when the Fed chooses inflation, people who hold 30-year Treasury bonds choose to sell them. And they also choose to buy gold. Gold was down.
Official claims of maintaining a strict 2% inflation target are entirely disconnected from operational actions. Despite widespread market anticipation of rate hikes, central bank leaders repeatedly voted to keep benchmark rates unchanged at 3.5 to 3.75%. Refusing to tighten monetary policy demonstrates an implicit preference for persistent inflation over economic contraction. Consumer credit, corporate borrowing, and government debt continuously expand, ensuring excessive purchasing power pushes consumer prices higher. In response to this policy inaction, Treasury yields have surged significantly, with 30-year bonds reaching yields not seen in 2 decades prior to the 2008 financial crisis. 10-year Treasury yields will easily push past 4.7% as bondholders dump government debt. Without genuine credit contraction, inflation momentum will resurge, triggering deeper sell-offs across major stock indexes. Now, let's get back to the interview.
3 FOMC members that did vote for a quarter-point rate hike, but Kevin Warsh was not among them. He voted to leave interest rates unchanged. The rate is 3.5 to 3.75. By the way, that's where the rate has been since December of last year, when the Fed cut rates by 25 basis points. But for 5 months before Warsh took over, rates were exactly where they are right now. And Warsh has been FOMC chairman now for a couple of months. This is his second press conference that he had today, the second opportunity that he's had to match up his rhetoric with actions. The markets thought there was a 30% chance of a rate hike. Why not deliver one? The fact of the matter is, and I've been saying this from the beginning, he's all bark and no bite. He can talk the talk, and he talked it again today, but he can't walk the walk. And the markets now are starting to take notice of what I have been talking about. Now, first of all, before he took the Q&A, he delivered his prepared remarks. And during those remarks, number one, the first thing he did was praise the committee. Oh, how great the committee is. They've done an excellent job, right? Everybody is great on the FOMC. Talked about how great the economy is, how resilient the economy is. And I think he does that because that's what Trump wants to pretend. So I think he wants to continue the pretense by reiterating how we've got this great economy so Trump can take credit for it. But then he continued about how the Fed is resolute in its resolve or to bring down inflation. It's resolute. And he also said that given the fact that inflation has been above 2% for over 5 years, that the markets may believe that the Fed really has a inflation target above 2%. After all, if the inflation target really was 2%, then why would the Fed tolerate it being above 2% for so long? Maybe it's a soft 2. Maybe the Fed has a secret target that's north of 2, and it's just not letting the markets know. Well, what Warsh wanted to make sure is that that belief was extinguished, that it's not the case, certainly not under his watch, even if that may have been the case, and he didn't admit that it was, but he made it clear in his rhetoric that it's not the case now, that the Fed does not have a secret target higher than 2%. 2% is the target. Now, of course, it also means that if 2% was the target all along, if there was no secret higher target, then the Fed failed. The Fed was not able to achieve 2% inflation, despite the fact that that was its goal. And of course, the reason that the Fed never achieved 2% inflation was for precisely the reasons that I stated in the past. Monetary policy never got restrictive enough to reduce inflation to 2%. In fact, monetary policy remained accommodative despite all of the Fed's rate hikes, because the entire time the Fed was hiking rates under Powell, money supply growth only shrank briefly, credit never contracted, the government, corporations, individuals continued to borrow more money. So you had more credit chasing a supply of goods. Remember, inflation is not just the expansion of the money supply, but the expansion of credit, because you don't need money to buy stuff. Just ask just about any American. You could have no money and keep on spending because you can spend credit as easily as you can spend money. And spending credit also pushes up prices. That's the demand. If the Fed wants to get inflation down, it has to bring down that demand, which means it has to raise rates enough to tighten credit. Consumers have to borrow less. The government has to borrow less. Businesses have to borrow less, but none of that happened. Everybody kept on borrowing and kept on spending, and that's why inflation didn't go back down to 2%. Now, it went down a little bit. The taper, the rates came down from the peak, but that was just temporary. Now we're seeing a resurgence because the inflation fire never got put out. The Fed didn't want to, because as soon as you got problems in the economy, as soon as you got banks that were failing, that's when the Fed stopped hiking. Gold, which had rallied about $80, sold off, but it never went negative. It never went below 4,000. And in fact, it closed up about $40 on the day, about 4,070. And silver, which was up about $1 and change at one point, sold off to about unch and then ended up closing up about 50 cents at 57.50. And the reason that gold and silver traders are worried about rising yields is they think, well, that's bad for gold because higher interest rates are bad for gold. Higher bond yields are not necessarily bad for gold. It depends on why those yields are rising. And if bond yields are rising because bond investors are losing confidence in the Fed, because bond investors are worried that inflation is going to be higher because the Fed is too timid to hike rates or slow money supply growth because it's too worried about adverse effects on the economy, that is also bullish for gold because the loss of confidence in the Fed is why you buy gold. If you're worried about higher inflation, that's why you buy gold. It's the same reason you wanted to sell treasuries. In fact, the smart thing to do as a result of what happened today is to sell treasuries and buy gold. And clearly, some of that happened today because treasuries went down and gold went up. Gold is the last safe haven standing. And a lot of people I know recently have been questioning whether gold has lost its luster as a safe haven, whether it's no longer a store of value or an inflation hedge. Yeah, that's all a bunch of BS. It hasn't lost anything. All people are looking at is, oh, gold got to 5,500 and it went down to 4,000. Who cares that it went to 5,500? It's at 4,000. Where was it a couple of years ago? Where was it 10 years ago, 20 years ago, 25 years ago? Gold hasn't lost anything. The problem is a lot of people never really had confidence in gold because they never really understood it. And they had a lot more confidence in the Fed because they didn't understand the Fed either. They don't understand the Fed and they don't understand gold. But I think more people are going to start to understand that as they start to perceive the dilemma that the Fed is in. They can't hike rates and they can't not hike rates because the markets are going to go down regardless of what they do. Now, the dollar was down today as well, not a lot, but the dollar index slipped back below 101. I think I'm looking at it 100.84. So again, that's also a bad sign, a loss of confidence. Rising interest rates didn't help the dollar. Now, again, it's long-term interest rates. We didn't get a rise in short-term interest rates because the Fed didn't have the guts to raise them.
Rising Treasury yields reflect a catastrophic breakdown of investor confidence in central bank capabilities. Escalating bond yields demonstrate that institutional investors are fleeing fixed income assets out of fear that unaddressed inflation will continuously erode purchasing power. Under these market dynamics, smart capital is actively shifting out of government treasuries and directly into physical precious metals, which remain the ultimate safe haven assets. Gold prices have demonstrated steady resilience above $4,000 per ounce, while silver maintains strong upward price momentum despite broader market volatility. Skeptics incorrectly question gold's historical role as an inflation hedge during minor price consolidations, failing to recognize its long-term monetary stability compared to rapidly depreciating fiat paper currencies. Furthermore, the US dollar index is predicted to experience ongoing downward pressure, slipping further below key support levels near 100.8 as investors reject artificial interest rate caps. The broader stock market will inevitably follow falling bond prices lower as borrowing costs rise across the entire economy. Precious metals will continue serving as the primary store of value while systemic market risks accelerate. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.